Can the Federal Reserve thread the needle? This is, I think, the question du jour. And the reason that it's the question du jour is because investors don't want it to end, right? It being the super accommodative setup that we have had for a decade, right? I mean, these are aligned so that you can see what the S&P 500 has done relative to what's been going on with the federal funds rate and the federal balance sheet. And I mean, has this bull market been fueled by very accommodative central bank supports? Yes, there's no doubt in my mind that that has been a key reason that we've had this very long and very strong bull market in the broad, in stocks broadly. And the thing is, that is now ending. And I think, and it has to end, right? I said the title on the last slide was, does it have to end? And it does have to end. And it has to end because inflation is at 7%. And inflation cannot be at 7%. We do not want our hard-earned savings being eroded at 7% year over year. That's not okay. So yes, it does have to end. And whether 7% is even a sufficient assessment, is another topic. So it does have to end, which brings us to the current setup. And I think that setup really got the light shone on it last week. And so I'm going to run through what I think happened last week and what I think it means, how it changed my outlook for what's going to happen over the next year. So over the last decade, during this super accommodative Federal Reserve stance, the Fed spent a lot of time assuring everyone that it will never surprise us again. It will telegraph every move that it makes. And we believe that, and that's fine. That is the new outlook. So during the fall, Powell laid out a clear plan to taper quantitative easing, so to buy fewer and fewer bonds over sort of a 9-month period, after which they would consider raising rates. That was the plan. And then inflation, which was already hot, really started to rage. I mean, details, but went from sort of just above 5% to more like 7%. The transitory notion really had to get kicked to the curb, and the Fed was forced into faster action. What's interesting is that happened in November and December, which is, some time ago. It is now January. But I think it really took until last week before a bunch of the market accepted what was happening. Because even with inflation above 5%, many in the market didn't want to believe that the Fed would, in fact, tighten more quickly. And there were lots of reasons that traders could hold on to for, oh no, it won't happen. I mean, we've had some very weird years with COVID. We've been assured that we wouldn't get surprised by the Fed ever again, and they laid out that clear plan. There's been such immense fiscal and monetary support for so long that it can't really go away, right? This is the new normal. The Fed did backtrack on its last hiking effort, so that made everyone sort of discount hiking. And then we've had this insane bull market, and this bull market has become a mainstay of the Fed's counts of success and sort of the count of success of the overall economy. Nobody wanted to upset that boat. So these were all the reasons that people held on to for, oh no, the Fed isn't really going to tighten that quickly, are they? Well, then the minutes from the Federal Reserve's December meeting hit. And it's hilarious to me that sort of long, dry minutes from a meeting that happened 6 weeks ago, about which there was already a press conference and a dot plot and lots of conversations. It was the minutes that actually got everyone sort of, oh my gosh, this is happening. And what happened is that those minutes hit last week and the bond market flipped. Is that an exaggeration? Well, the chart that's here on the left is the total weekly returns. So that's a way of accounting for bond price and yield over the duration of the bond. So the total weekly return for the 30-year bond. When those minutes hit, that week, the 30-year had its worst week in 49 years. The 10-year had its second worst week in 49 years. I mean, the bond market sold off hard. And why? Because there was this final acceptance that the easy money is over. And that cued a scramble to get out before the Fed stops buying. And that makes a lot of sense. The Fed has been a massive and, importantly, a completely price insensitive buyer and has been so for a very long time, especially over the last 2 years, but has been so before that as well. And so there was a scramble to get out before the Fed stopped buying. So that's what happened. And bonds really felt the pain. The Fed has to tighten. Because like I say, if we can't have inflation at 7%, that is the reality of that. But this is an example of the fact that tightening will have repercussions. Reality has repercussions. We can't just carry along in exactly the same way that we have been. I would say as bonds were going through last week of pain, we also saw a lot of damage in sort of the high speculative end of the stock market, profitless tech companies, which have been a huge darling, right? For many years now, they had a very bad week. Brand new IPOs, cryptocurrencies, these things all also had very tough weeks. So I think that last week might be a good preview of the kind of reaction and volatility, the kind of reaction to tightening that we are going to get as we move through the year ahead. It is a big deal that the Fed is tightening. And the Fed is tightening because it has to, but in tightening, it also has to thread the needle. And this is a very tall order. So the Fed has to get inflation under control, but without inducing a recession. And recession can be characterized in whichever way you want to. The Fed will include in its characterization, a stock market correction, because like I say, a strong stock market is now fundamental to our perception of economic success. And so this is all a problem, because this is a quote that I grabbed from another newsletter writer, and I think it just sort of captures what's going on here. Free liquidity, all of the support has become the drug to which Wall Street is addicted, and the Treasury is also addicted. The bond market is addicted. Everyone's addicted. Withdrawing will have side effects, and in that, the Fed has no choice but to aggravate someone this year. And so how's that going to play out? How it's going to play out is the big question of 2022. And I don't have the answers, but I do. And the reason that I don't have the answers, one is because I don't have a crystal ball, but also it's because it's complicated out there. There's a lot of possible events, data points, happenings, and they all sort of crisscross with each other in terms of how the market will perceive their impacts, what the impacts will actually be. It's a complicated web. It's myriad possibilities. So like, for instance, will inflation ease sort of on its own and or with tightening from the Fed? That is sort of what's happened in China. And I mean, sure, China has other issues going on with its debt markets, and the Evergrande situation is sort of the big example therein. But nonetheless, China is sort of 6 months ahead of the rest of the world in its COVID path. It saw strong inflation, it raised rates, and then inflation and growth really stepped back. And so is that the path that the rest of the world is going to happen? Or will inflation persist, with service spending stepping up as COVID goes endemic and the labor market stays tight? Will it persist? I don't know. Will stocks tolerate tightening, or will the stock market throw a fit? I think that's a very real and actually quite important question. Will bond yields keep rising? I mean, they rose a bunch last week. Will that continue? Or, sorry, my diabetes monitor was giving me a warning there. Will bond yields keep rising? That will raise the cost of debt. Will rising debt service costs hurt the stock market? The chart that I have here just shows how closely correlated stocks are with earnings per share. And so, if debt service costs rise, that impacts earnings per share. So these are some of the more fundamental, more real reasons why the changes that are coming over the next year are likely to have real impacts in the markets. Okay, so it's confusing out there. There's a lot of different things that could happen. What do I think is certain? Well, volatility. I think volatility is absolutely certain. I am certain that it will be very hard to predict how certain data points will be taken. Like over the next little while, I don't know whether strong inflation prints will be considered good or bad for gold, because you can sort of argue that both ways, whether it's increasing tightening expectations or whether it's keeping real rates more negative. One perhaps is a downward pressure on gold, and one is an upward pressure on gold. I think it's very hard to know how data points will be taken in the next little while. I I am pretty confident that gold will be range bound until this first hike. I had thought there would be time for gold to enjoy its more normal seasonal run, but that's when I thought tightening wasn't going to happen until May. So I thought, okay, January, February, we'll have time for the seasonal run. And then all of this Fed positioning will really take over. Well, no. If the first hike truly is happening in March, there isn't time for an outside of the Fed situation to evolve in gold. Gold will only be impacted by this web of Fed-focused possibilities. And so I don't think that there's time for a seasonal run in gold. And if gold does slide some into this first hike, moves towards the bottom of its range, that is because it is pricing in higher real rates. Now let's keep that in context. Real rates will stay well negative, right? This is a very basic chart of real rates, by which I mean this is simply the federal funds rate minus inflation. Is that a real way of looking at real rates? I don't know. Usually you use the 10-year minus the 5-year inflation expectation. There's other more nuanced ways of looking at real rates, but this is a very basic one, and you can see how negative real rates are. We will stay in a negative real rate environment, but real rates will come up if we get higher federal funds rates and lower inflation. That is how the math works. So those things I think are certain. Out beyond those, outside of those certainties, some of which are fairly short term, what else do I see ahead? Well, I see a pretty strong correlation with gold and rising rates, right? And this is something that I bring up a lot because it is a bit counterintuitive, and yet it is very reliable. The lines all mark, right? The bottom of the chart there is the federal funds rate, and the top chart is the price of gold. They're lined up, and you can see that increases in the federal funds rate, especially after a long decline, a significant decline or a long low rates period, then gold rises with rates. And that's because rates rise when we have inflation and when we have growth driving inflation and commodities as a whole. So that's why that happens. That's important. Because even if I am not sure if I'm not confident in gold performing in an exciting way into the first rate hike, I am confident in gold benefiting once we finally get to that point. Moving on to the base metal side, I mean, it would be best if the Fed could thread the needle for base metals, right? Then we could continue to have growth and we could tame inflation and everything would just carry on. I don't think it's particularly likely that the Fed will thread the needle without some sort of upset one way or the other. But it's important to note that there's really tight supply-demand setups in multiple base metals, most of which, in most of those situations, those tight setups are driven by the green energy paradigm shift. And so I think that gives reason to believe that a good number of industrial metals, copper, met coal, nickel, PGEs, I'll get to uranium as the final thing that I'm talking about in my presentation here, should survive a recession or whatever sort of upset we get without a lot of damage. There's just very strong fundamentals in those areas. And I think it's also interesting to note that of late, in the last week or two, it's a very short-term window, but nonetheless, investors have done some turning to value instead of growth or spec. And growth and spec have been the standout focuses, right, in the market for years now. But if there is a rotation to value in the face of this uncertainty and the fact that some apple cart is going to get upset over the next year, then that works. The same sort of thinking applies for gold, right? Okay, then there's uranium. I have 3 slides where I'm going to try and explain uranium. This is therefore going to be a brief look at what's happening, but nonetheless, I'm going to run through it. Realize back 6 years, in 2016, the producers of the world decided that they needed to fix an oversupplied market. It was a great collective decision. They shut mines, they reduced output, they started sequestering pounds, and that really worked. Output fell significantly, and the production cuts and sequestering started a slow improvement in the price, as this chart can show. Then we had COVID, which boosted the price in its own way and whatnot. Then last year, we got the Sprott Physical Uranium Trust. It entered the market with $300 million in buying power to raise that money and go buy physical uranium. Then it increased that to $1.3 billion. Oh, no, wait, then it increased that to $3.4 billion. And it did that because there was enough interest and because they are doing this in order to, as a bet on and a way to help create higher uranium prices. It's a conviction position. And by creating this fund, they're giving investors an easy way to have direct exposure to that uranium price opportunity, which is great. Other funds, the sequestering that I've mentioned here, that is funds buying uranium to squirrel it away. So other funds have absolutely done this before, but SPUT, as the hilarious acronym comes to be, brings scale, $3.4 billion worth of scale, and timing to that sequestering notion. And the timing matters because nuclear truly is rising. China is building 150 new reactors over the next 15 years. That's more than the rest of the world has built in the last 3+ decades. Demand, and because of that, primarily China, also other parts of the world, but China is the one that really matters. Demand is growing and it will continue to outstrip supplies. I say continue to because demand has outstripped production for years now. Secondary supplies have filled the gap, but that's where the sequestering has stepped in, right? Sequestering is drying up those secondary supplies, and we end up with significant cumulative gaps that don't have the supplies to fit to step in. There we go. Oops, I skipped a slide there. I do think that uranium is going to have an exciting year. This slide is just to remind you that when a uranium bull market happens, it puts gold bull markets to shame. It can be a very short-lived event. It's incredibly exciting. You need to pay a lot of attention, but the gains can be unreal. The reason that the uranium price can move so dramatically is because utilities have to secure uranium. It's not a choice, it's a requirement. They pile in as a group when it happens. Then speculators who have seen this happen before add to the pressure. And it's just a small market, so that means big price moves. Then on the equities side, you get multiples of gain against that already major uranium commodity price move, because there's just hardly any stocks out there. The uranium market is really tiny, and so there's just not that many places for investors to push their money. So that's the uranium situation. It's a little different than the others, but it's happening at a I'd say a convenient time, because it is, it's better when commodities move together, and there's reasons for that to be the case. Okay, so what are the takeaways? The end of quantitative easing, which is happening. It's not an if, it is happening, removes a key buyer from the bond market. So prices are down or yields up. How far is that going to go? What will higher debt costs do? I think that's an important question to keep in your mind. The Fed needs to thread the needle. It's trying to choke inflation without upsetting too many apple carts, but that's very tough to do. Something is going to get upset this year. I don't know exactly which, but something is going to get upset. If we get any bond or stock market mayhem, the Fed will rethink its tightening plan. Again, I don't know the details of that, but I think that that's a confident statement. I think gold is range bound to maybe down until we get that first hike over with. And now that that's pretty soon, there's no time for a seasonal run. But then gold rises with rate hikes. So yes, I'd love it if we could just fast forward to March, but it's January, so we got to get through the next 2 months. The fundamentals are very strong for a multitude of base metals. So I think regardless of what happens, those long-term bets still make a lot of sense. And I think we're likely looking at a uranium bull market in the next 12 months. That is what I have to say. It was I did a lot of rethinking of my entire outlook over the last week. And so you heard it here first. And you can talk to me in 6 months about it, whether it was all nonsense or whether I had anything useful to say.